Hi, everybody. Welcome to another KE Report webinar, and then KE Report webinar that I'm excited for because we have our good friend Sean Brodrick on with us from the Oxford Club. Sean Brodrick writes the Oxford Resource Explorer, Gold and Resource Profit Hunter, and Energy and Resource Digest. Sean, you're an awfully busy guy, and that's why I always appreciate you taking some time out and joining us and taking a prolonged period of time today to share some of your thoughts on the precious metals. It seems to be what we're going to focus on, but we are also going to be fielding a lot of questions. So please, everybody, use the question panel on this GoToWebinar portfolio. It will come to me, and I will be able to ask Sean those questions throughout his presentation, but then also at the end, we'll have a prolonged question and answer period. And just so anybody who does not know who I am Cory, the president and host of the Corlin Economics Report, or KE Report. As we go by, we have a 2-hour radio show that goes around the U.S. on, well, the weekend, and then every day, daily market commentary focused on the precious metals, but also talking about other economic moves. So it's always a blast to have guests like Sean on with me, who we're joined by on a very, very regular basis. If anybody's having any trouble, you can also email me at fleck.com or at kereport.com, and I will be sporadically checking those throughout this webinar. So Sean, without further ado, I'm going to throw up your presentation here, and we can get going. 1 second as I do that, and here we go, Sean. First of all, nice picture. Looking good there, buddy. I'm going to cut off our webcams as well. And then
because I can't see it. One thing I could do is I could access it on my computer, but I can't see what you're showing right now.
Okay, you should be able to pull up something in this program where you would be able to see. Do you have an audience view panel up there?
See, what's that? No. Let me try something else. I'll escape from that. And
I'm going to turn off our webcams and hope that this helps bring this up. And application, show. Sorry, everybody. This usually does not happen. This usually runs much smoother.
So is it just me who can't see it, or everyone who can't see it?
It's looking like everyone who can't see it. So this is actually kind of confusing why that would happen. Let me pull this up and see if I can almost restart this.
Well, while you're doing that, let me tell folks that we've had some very exciting things going on in gold, which is that we saw one of the big indicators for the gold market has to be what is going on in the gold ETFs. And after hitting a peak in like last year, we saw gold sell out of the gold ETFs. It was a big sell-off. And it actually continued in the U.S. into January. There was huge selling in the gold ETFs through January in the U.S. And I'm emphasizing that because a lot more demand came in from China, and it more than made up for the selling of the gold ETFs that was going on in the U.S. And so all the gold ETFs around the world. There we go.
Now we're online. Here we go.
All right. Yeah, all right. Let's actually start with the previous slide, because I actually put that up just in case Al sees this. That's Al down on the lower right. That's me. That's a trip that I learned to pan for gold on. I was with Al. We were up in the Revelation Mountains up in Alaska. It was great fun. Such a trip. I mean, you know, because we had to take bush planes and land in a riverbed and all this stuff. And, like, we learned to pan from a guy who was, like, missing half of his fingers on one hand and most of his fingers on the other. Basically, I don't know how he got around, but he loved going for gold. And this is a place that had visible gold. That's what I'm actually showing you there. That doesn't mean it's economic. What you need to do is you need to find gold that's actually visible, or really just higher grade gold, and is economic. And so I think someone's trying to make a run out of that, but that's a tough place to actually mine because the weather is so severe. But let's move on to the next thing, which is, let me tell you about the big market in gold. It's just getting started. I just updated this chart this week, and gold is cyclical, probably as most of the listeners and viewers here know, and it came out of a 52-month brutal bear market, and that bear market ended in January of 2016. We saw a big rally in gold in the first half of last year, and things then went into a slow decline. That was very depressing for many of us who thought the bear market might be done. But actually, this happens all the time. Every bull market has these big swings up and down that, if you look back in retrospect, people hardly remember them. But that's the kind of thing we saw was, you know, the bull market started again. It really got ahead of itself. It had to pull back. And now it seems to be turning around again. I'll have some more stuff about that in here. But we should get a 5 to 7 year bull market even in ordinary times. And the early years are ones in which you can make a heck of a lot of money. As anyone who was in the market in the first half of last year knows, I mean, we made some tremendous money. I hope you did too. And that opportunity is coming around again. Let's.
Can you quickly talk about if you think this bear market, that 4.5-year bear market, was one of the worst that you've seen?
Well, it's one of the worst that I've seen. It's probably not one of the worst. You know, that's the problem, is we all have like survivor bias, right? And so it's. I mean, God, I used to work with a guy named Charles Bolita. And when I worked with him, he was in his 80s. We only worked tangentially together. We were not employed by the same company. Anyway, when he started on Wall Street, he had an outhouse. That's how long he started on Wall Street. And if you talk to him during like a bad time in the market, he always had a story about a good time. If you talk to him a good time in the market, he always had a story about a bad time, because he tried to bring perspective, and so that's what he was always trying to give younger people, is that, you know, it's never as bad as you think, and it's never as good as you think. You have to be prepared for what's about to come around the corner. Now, this bear market was certainly an awful one, and I have to say, I sometimes think that the real chaos in the markets might be accelerating because of the machines coming in and stuff, right? And like when they want to sell, they sell. When they want to buy, they buy, and it pushes things around so they get to places faster than it might have otherwise. So to answer your question, there was a long and brutal bear market. There have probably been worse, but certainly that's the worst one I want to go through.
Well, and touching on your point there, Sean, about some of these, I think you're talking about high-frequency traders and algo traders. Unfortunately, that's just the market we're in right now. So we almost need to treat that, I believe, as the new normal, wouldn't you say?
Right, but that's why it's good to look at a chart like the one I have here. You have to take a longer-term viewpoint. Those algos, those high-frequency traders, they are trading in fractions of a second. Their outlook is no longer than a minute. And so if you take a longer term view, you can actually beat them. You just have to have different goals and just not actually try and make money every day, but over the longer term you make money.
I agree. You want to move on here, Sean? Let's take a look at the next chart.
All right. This one, these are some things that I picked up from Bloomberg. They're great charts, and it just shows what the bear market did to exploration spending by miners, and also what's happened to their reserves because of that. But well, you can see where this is leading, which is that basically miners don't have nearly the pipelines they should, so they're going to have to buy up juniors to fill those. But I would add to that, there has been a change in the business model. It used to be every big miner had teams of geologists that would, you know, roam a continent or continents looking for good projects. The business model now, and speak to anybody in the business, they can attest to this, is that they wait for the juniors to build up great companies, take all the chances of like success or failure, and then they just finally buy it because they're cash rich anyway, right? They just need to add certain projects in the pipeline so that everything comes together. They need to think the next 5 to 7 to 10 years down the road. And so they want, okay, this one will fit into that slot, so we'll do that, and like that kind of thing. So it's a change in the business model. And I mean, it was actually great for junior mining because all those exploration teams were cut loose. And I drove around Nevada once for 3 days with the former exploration team for Placer Dome mines, and they knew more about Nevada than you can imagine. It was just a graduate course in the geology and the history of the area and all that stuff. It was really, really cool. But and these guys know how to find projects, and that's what they do as a small exploration miner. They are going out where they think the good next projects are, and they're trying to find them, and they have to, because the gold miners reserve, the big gold miners, their reserves have just shrunk because they are not spending the money on exploration anymore. Now, one reason they weren't spending money on exploration is because of the terrible bear market, and as prices go higher and the price of gold goes above $1,300, which I think it could easily do this year, and $1,400 and higher, will the big gold explorers start spending money on exploration again? Or else will they instead just start to buy up more companies so they have kind of a land bank going for them? I think it's the second alternative is what they'll do, because they've really changed the business model and the way that they operate now. And so that's just something to keep in mind when you're looking at the junior miners, which I know many of your listeners like to look at. Is I think there's some extraordinary potential for them this year and the next year and stuff like that, where we could see some things snapped up as the big miners look at these empty pipelines and they say, you know, we've got to fill these things up.
One more comment on this, Sean, and it's something that was brought up a lot at the recent conferences in Vancouver, is that you are right. The business model of some of these majors has changed to the point, at least recently, where they're more taking equity positions in a lot of these exploration companies rather than getting into M&A battles. We've seen Goldcorp recently, we've seen Anglo, them all put maybe 10 to 15% equity into these exploration companies so that they do have an inside track on what obviously they think are some of the best exploration teams. And I think that goes hand in hand with what the major companies have had to do, and that is alleviate costs on the ride down from that just over $1,900 gold that we hit. They've been cutting costs, and some of the easiest costs to cut immediately are the exploration costs. Have you noticed this trend as well? Instead of M&A activity, we're seeing more slow equity raises and positions in these explorers?
Yes, and one reason they do that, and this was hammered home to me during my last trip to Nevada, which was not that long ago, as a matter of fact, was the reason they do that is because they then open up a channel of like a back and forth communication between the big company and the small company, sharing information. So sometimes the small company doesn't have the resources to really analyze what it has. It'll go to the big company, which has taken an equity position, say, this is what's coming up. What do you guys think and stuff? And that's great for the big company because then they can decide to raise their equity stake if they want to. They can give those smaller companies some like real guidance and like stuff like that. So yeah, that seems to be a new business model that's really working for them now.
So do you take more interest in these companies that have already gotten some sort of an investment from these majors?
Oh yeah, I like the ones that have some big fish has had a stake in them. I like the ones that have more than one big fish. I mean, there are companies out there that have two major companies investing in them and stuff. And so that kind of tells you, you know what, they're going to find something because two larger miners are both starting to take equity positions in these things. You can see it all over the place. And that's actually one of the things I look for, because you don't have to buy the thing when it's 8 cents, right? You can wait until it's actually moving along and they have some kind of vision, because when they have some kind of vision, that's when the larger companies will actually get interested, start to put some money in, and if the big companies find a good reason to invest in a smaller one, maybe you want to do too, because it can go a heck of a lot higher.
Oh, and that's honestly where you take some of the risk out of the game too. It's fun
Yeah,
to
right.
invest in the 5-cent stocks, but sometimes the $1 stocks can be much safer and help you sleep at night. But that
Yes,
being said, Sean, let's move it on here. Let's check out another gold chart, a slightly longer term gold chart that shows the zigzags that gold inherently as a market puts up with.
Right. I mean, this is the big gold cycles that we have, but the beauty of it is it also trends. I mean, we know gold trends, as many investment trends, and it's near the lower trend line and has turned up. I think you can't say for sure whether it lowers your risk, but it seems lower risk to me to actually take positions in things now, because of how close gold is to support and how it's been zigzagging rather regularly. And so from a technical perspective, things look less risky. Then we have to separate technicals from the fundamentals. We can have a big argument about the fundamentals too, but technically I think gold looks less risky here.
And I would agree with that, Sean. I spend a lot of time on technicals and looking at the broader picture for gold, especially where we're trading right now. We've gotten above a short-term resistance point that was around 1210, and we continue to climb higher. So from a technical basis, if there are any technical traders out there, feel free to email me and we can share some charts, because I find that to be a lot of fun. We don't want to bore some of the other people who don't like looking at charts, but let's just both agree that technically right now, barring any sort of a major breakdown, gold looks to be putting in a much more solid bottom, a much more solid base than we've seen in quite some time. Because if you look at this chart, 2009 to 2012, that's almost a straight up move. That doesn't normally happen in charts.
Yeah, you're right. And that caught a lot of people by surprise. Some people kept waiting for a pullback that never came. Then when the pullback came, they said, aha, this is it. This is the rest before we go much higher. I know, because heck, I was getting swept up in that too. I thought gold could go much higher. But there's a lot of forces in play, which, we'll touch on in a bit. But just when gold really wants to move, it is a beast. And you can't tell where to go. You just have to follow along. But right now, it looks like it has come down, touch support. It could go touch it again, but this is one of the lower risk entry spots you could choose.
Absolutely. One of those buy low type of strategies. And right now, no arguing that it is at a close to a low, let's say. Now, Sean, you were mentioning how gold can really get moving. And one of these factors that really starts to move gold, and any market for that matter, is big money coming into the sector. And big money to me means ETFs. Here's another chart that you wanted to share with everybody.
Right, and this is what I was speaking about when we couldn't get the charts up earlier, is that the ETF holding of gold, it's a major force in the market, and it's how the big funds take positions in gold, because they have to hedge their bets and that kind of thing. And it really ramped up through October, and then we saw this slow decline, this bleed out of money that was giving everyone second thoughts about the market. Second thoughts that continue today. I see a lot of people who have been very bullish in the past who are now, whenever they put up a chart, they're always hedging their bets and like speaking about, potentially, possibly, and stuff like that. So a lot of the bullish sentiment has come out of the market, which is actually bullish. We can also get into why that is too, but that's different. But this slow sell-off has stopped. In January, looking at all the global funds, not just the ones in the U.S., not just the GLD, but all the global funds, we saw 8.8 metric tons picked up by all the global ETFs. Now, in the U.S., the GLD was still selling furiously, but it was overwhelmed by the demand from China. And so those ETFs over there picking up more gold. And so then Wednesday, just yesterday, something happened in the U.S. ETFs. Some kind of like thing snapped, and so $413 million poured into the GLD yesterday. That was like that was the most in like many, many months, and it like pretty much undid a good chunk of what had happened in like January. And so this shows that we're really seem to be hitting some kind of a bottom in the ETF demand. And you can't discount that because that's one of the forces in gold now. We didn't used to have ETFs. You didn't have to figure them into the markets. Now they exist, and they can buy a lot of gold, especially when things turn bullish. The thing about ETFs is they really add to the bullishness on the way up because they're snapping up all the gold they can, and they add to the bearishness on the way down. And that makes both the moves up and the moves down more extreme. Well, we just had about as extreme a move down, even though it was only a smaller correction, it was probably more extreme than it could have been because of the ETF selling. But the ETF selling has stopped now. Maybe it'll pick up again, but it sure seems like it's hit some kind of bottom. And so, the reason is, as I'll show you on the next slide, buying from an unexpected source. Let's move to that next one.
Sure. And one more comment that I just want to make on this ETF buying is recently we did see some funds out of the U.S. The Globe recently reported that IVA, Ridgeworth, and Fidelity are turning bullish on gold. That doesn't mean they're throwing money into the sector, but they are realizing that they are under-allocated. And when you have big funds like this, their really only option is to go into the ETFs. And that might be some of the change that you saw yesterday, Sean, because this story did break yesterday, which is a big change.
Right, and so the new demand I was speaking about is from China, and they just want the bullion. Now, this is making up for the fact that there's less buying of jewelry and like that stuff over in China, which has actually kind of put kind of a weight on the market because people look at the jewelry buying over there and say, you know, that's not good, so maybe we shouldn't be bullish. But the Chinese have a new way to buy gold, and probably one that's not as flashy. And if say you were a say you were a bureaucrat who had, let's say, unexplainable millions in your bank account, which happens more than you might think over there. You know, I mean, walking around with flashy jewelry is a good way to get hauled out of a Hong Kong hotel and never seen again, which just happened to someone in China the other day, as a matter of fact. So I think that the ETFs give them another way to actually invest in gold, and it's going to be a bigger force in the market. It's going to be a bigger force in the global market. And one reason that they might want to invest in gold is because, as scary as our economy looks sometimes, I mean, it actually looks much better more recently, but sometimes it's scary, right? China has a scary economy. They are having this credit bubble like no one's ever seen. And so people are wondering how it'll unwind. Can it deflate safely, or is there going to be some major chaos? No one knows. If I was a rich investor over in China, I would want something that I could actually count on tangibly. And so you can bet there's some people allocating some of their money to the GLD so they can say, well, not the GLD, but the Chinese equivalent, just so they can say, look, I have this much in gold. If the rest of the stock market falls apart, at least I have that. And so I think we'll see more of that happening in the market.
And this has been a trend over the past number of months, almost all last year, is capital outflows from China. This just goes hand in hand with, I think, them returning a bit more to gold, because we did see a slight decline in some of China's demand for gold about a year and a half ago. Sean, as kind of a side note, do you have any opinions on the Shanghai Gold Exchange and the Shanghai Gold Fix, if that's changing the market of pricing at all?
I don't know if it's changing the market. We haven't seen it yet, right? I mean, but exactly. Certainly it's like more demand in the market. It's another way for people to actually buy gold. So you have to think that is kind of bullish longer term. And we know that the Chinese have a cultural affinity to gold. They just do. So I would think that would be bullish, but we'll see how it works out.
Absolutely. All right, now let's come back onshore to the U.S. and talk about the Fed. We had the FOMC minutes released yesterday, actually, the statement released yesterday, and the title here says, "Do you think the Fed is turning hawkish?" Their comments yesterday really didn't make you feel that way.
No, no, no. And this is this is what I've been saying for a while is people are expecting 3 rate hikes this year. I think one, maybe 2. I mean, because back in 2015, 2016, they were always talk more rate hikes. We'll have more rate hikes. They never have them. And this time we have uncertainty in the market, which is caused by policies. Will we have a trade war? Not have a trade war? That's what the Fed has to worry about. They can't worry about what's happening with like share prices, whether your stock in like GE is actually going up or down. They have to worry what the big picture impacts will be. And if we do things like rip up the North American Free Trade Act, I mean, they don't want to be tightening at the wrong time if that is problematic. Maybe it will be, maybe it won't. Maybe we'll rip it up, maybe we won't. That's the thing. When you have uncertainty, you have to find safe harbors. And one of the safe harbors is gold. And you saw that on Wednesday, by the way. When the Fed came out with its statement, people looked through it, didn't see anything saying they were going to raise rates anytime soon. The dollar went lower, and we saw gold, which had sold off deeper in the morning, come back and almost close unchanged. So that was just an indication of like how that works out.
One thing that the note that you have here that I think is important for people to realize is this rotation of Fed governors right now with this new essentially board that they have of voting members. They are historically and openly more dovish than some of the recent ones that left. So that could have also played into the statement yesterday that as much as they, I think, want to give the market the idea that they're going to keep raising rates, it was very dovish. They were more than willing to be behind the curve on inflation.
Right, and now they have the cover because we have geopolitical stuff going on. That's the cover they need because you don't want to be the Fed governor or the Fed board member that kills the economy. And you know that's the fear that hangs over them. They don't want to be the one that pulls the kill switch. They want things to go along, maybe at a slower rate of growth than people would like, but still going along fine. And so, then they look okay. So I think that's pretty much what they're going for.
Kicking that can down the road, isn't it, Sean?
Yes.
Let's move on now. Let's check out some other bull market forces that we wanted to share. We have the U.S. dollar. That's been very much rolling over in the last couple of days. Even today, the U.S. dollar has reached the lowest level since Friday after the election. How that narrative has changed, hasn't it?
Yes, it has. And so this is a thing that's really affecting the market right now. Now, we did see the U.S. dollar bounce from its lows, which pulled gold back from its highs. But you can't watch the intraday stuff. It'll just drive you insane. What I'm watching is the trend. And the trend sure looks like the dollar has hit some kind of top. And it can be for multiple reasons. And gold has really hit a bottom. Now, we can go back to that much longer term chart that we saw earlier and saw that technically it has reasons to go higher, but there are fundamental reasons for it to go higher too. Growing middle class in Asia, central banks, they are buying more and more gold, even though they say, oh, no one needs this barbarous relic. What do? They buy it hand over fist, especially countries like Russia and China and stuff like that. Rising worries about the global financial system, which I already touched on. And this is part of the paradox of it, is we have improving economic data in the U.S., in Europe, in China, at the same time that fear is rising. And so I think this is why people are so confused. They're like, things are looking better and we're hiring more people, but I'm more scared than I've been in quite some time. And so when you're worried, people tend to put some money in gold. And then we have the dollar. It ran higher in anticipation of inflation and higher rates. I said inflation isn't picking up. It is picking up a little. What I mean is it isn't above the Fed's magic number of like 2% where they say, okay, now we have to hike rates. So it isn't picking up enough to actually trigger something like that. Bad news for the other currencies is probably priced in. We've even seen the Mexican peso, which was just taking a drubbing whenever President Trump would come out and speak about building the wall and like stuff like that. That started to pick itself up off the floor. So the bad news for the other currencies may be priced in. So we could see the dollar go lower just because there's not enough bad news for the other currencies that it trades against. And also, President Trump himself says the US dollar is too strong. One of his trade advisors just came out this week, said the US dollar is too strong. I believe they're trying to jawbone the dollar down. Maybe that's what part of this talk about, trade war and stuff like that, maybe that's part of their plan to jawbone the dollar lower. I don't know. But I know they want it lower. And if the White House is pushing to have the dollar lower, it seems natural that the US dollar will go higher. So that's the kind of stuff that I'm looking at fundamentally that I think will have a big effect on gold.
Sean, there is one more comment that I want to jump in here with, and that is your inflation comment, because some of the recent stats that came out during and in that Fed statement is that the 5-year inflation tips break-even level actually has just risen slightly above 2%, 2.05%.
Oh, really?
I just yesterday.
I missed that because I was focusing on something else.
No, fair enough. But this is what I wanted to bring up, is that the Fed, even though they admitted that this level did raise, they still consider inflation to remain low. They're almost now starting to ignore that 2% level. Maybe they're waiting for some follow-up data. That's what I found so interesting about their statement yesterday, is that inflation is finally starting to hit their targets, but they're ignoring it, which means they're still very much on the sidelines and confused.
Yeah, that will be really interesting if they're going to ignore it. I thought it was closer to 1.8%, but okay. I mean,
it's made a big move recently.
Yeah. All right. So if they ignore it, I mean, that would be a game changer. But again, I think that they have to take other risks into account, and these are risks that might be being stoked by the White House simply because they want the US dollar to go lower. They don't want it to go higher for very good reasons. It hurts our trade when our stuff is too expensive that we can't sell it overseas. So as they reshape these agreements with like other countries and stuff, it would help them if they had a lower US dollar.
Well, let's now talk about politics here and the Trump wild card in our next slide, and also touching on what you said about Peter Navarro, the trade advisor. He is very much against China, I would say. You just need to look at a couple books that he has written. But then even yesterday he came out and said, or maybe it was Tuesday, when they started looking at Germany and Japan and saying, hold on, these guys are currency manipulators too. This is all kind of in a big game to bring the dollar back to a lower level, I think. Right.
We have that, and at the same time, we have some things that are very pro-business happening at the same time. Right? So how confusing is that? Regulations will like roll back. Taxes will go down. Those are all the things, I think, that actually got everyone really excited after the election. But now they have to worry about, well, what would a currency war or a trade war with China look like? How would that affect any of my investments? The North American Free Trade Act, are we really going to rip that up? Can we rip that up? What the heck will that do? Sanctions on Russia, if those are lifted, that opens up possibilities for Exxon, which has some big investments there, other oil companies, and anybody that really wants to do business with Russia. Iran, I mean, there are not only hawkish people in the White House now, but very anti-Iranian. And so that could lead to some kind of action on Iran. He put Iran on notice, whatever that means. But, I mean, if you woke up tomorrow and it turned out that we dropped a few bombs on like something over there, would that be that surprising? It wouldn't surprise me. So we have this mix of like things which are very good for business and at the same time things that are very scary. And so that's why it's a wild card. Now, I do think taxes will be going down a lot. I think that easing the regulatory burden will help all sorts of companies, especially miners, I have to say. Miners and also oil companies. Believe me, when I drive around the like Badlands with these guys, half the stuff they bitch about is, this regulation, that regulation, just really things are slow moving. I think a lot of that might be going away, which will really lower their costs. They won't have to deal with it. And so that'll be good for them. So we have all the good, we have all the bad. It's a handful of wild cards. And so I just think we're going to have to stay on our toes for the next few months just until we see how things settle out.
So, Sean, I have to say that even before the election, I think a few months before the election, when I was talking to you, you were saying that you thought Trump had a much better chance than a lot of people were giving him, and you said it's very well likely that he could make it into office. Now that he is in office, his first, how many days has it been now? About 23 days, I believe. They've been pretty active. Did you expect him to be this active?
No, I really thought that he would ignore some of his campaign promises, as people who run for office often do. I didn't think that he would take any kind of a trade war, border tax with Mexico any further. We actually get a lot out of that agreement with Mexico, which is currently being ignored right now. It's true that more money goes down there, but that's because it's cheaper to make things there. We don't really want to complicate that if we want the U.S. car industry to keep going the way it is. I know that they can build new plants here, but believe me, there's so much stuff that goes back and forth across the border that it's just crazy. Now, yeah, he's been really active, and it seems that he wants to deliver on every campaign promise he made. To my Golden Resource Profit Hunter subscribers, I just sent them a report yesterday, which was actually talking about infrastructure. And in fact, your listeners may not know this, but right after the election, the Trump team rolled out this plan for an infrastructure build-out, and they gave it to the National Association of Governors, and it showed what they wanted to accomplish. And there is a heck of a lot in there. And so there's some real potential for U.S.-based companies to make some tremendous amounts of money, whether these are public programs, public-private partnerships, I'm not sure, but it seems like they want to push these things through. And so there's a lot that can really go on there. So, you know, there's both good and bad. It's quite exciting. But, I mean, if you have a company that, let's look at General Electric for just one of them, because I mentioned them earlier. A lot of their executives come from around the world. They don't just have people from the U.S. And so when we have stricter controls on the border, it's harder for their executives to move back and forth. And so that might actually slow down their business because of that. There's a whole bunch of things to think about. I mean, I just see some real opportunities too. So I don't think people should hide under a shell. There's some real opportunities here, and you really should make the most of them.
Well, there is a lot going on, and let's talk about some of these opportunities. Let's start looking at a few stocks that you like and a couple stocks that I have a few comments on as well, because that is what people want to know, is what stocks you're liking. Let's take a look at some of the miners first.
Sure. Well, Klondex, they work in Nevada, and they also have a mine up in Manitoba that they're bringing online right now. Nice high grade. I've actually been underground at the Fire Creek mine. If you check my videos, which are on YouTube, and I have a link to that at the bottom, I take you on an underground trip into their mine. It's very rare, and I've been in a lot of mines. It's very rare to see visible gold and silver, and Klondex has visible gold. I love high grade. This is a company that can find assets and turn them around, and has just done a fantastic job with its assets in like Nevada, and it just picked up some more assets in Nevada, and it has True North up in Manitoba. So it's taking the money that it's this like huge cash flow from its low-cost mines and using that to grow very smartly. So I think that's a company that people should really be looking at.
What about Barrick? Barrick's a big company. You think it's one of the best big companies to get into?
Right, and I have this in Oxford Resource Explorer. So, well, and actually I have Klondike's in the Golden Resource Provider, full disclosure. But I don't think people should overlook the big companies, especially when they're doing the kind of things that Barrick is doing. I was just looking at a list of the top 10 giant gold deposits in the world's biggest gold deposits. Barrick owns 2 of them and is a partner in 2 others. It not only has a huge amount of resources, it has very smart management. It's bringing in Cisco. I was at its mines out in Nevada. What are the names of it? Cortez Hills, and then the exploration project Gold Rush. I was there, and Cortez Hills, of course. Then they have the other one across the way, and then they have Deep South. It's this huge trend that they are just mining and mining and mining, and they brought Cisco in there to optimize and digitize the mines. And you say, how do you digitize a mine? A mine is a real physical thing. In fact, that's one of the reasons that I got into gold mine investing, because I couldn't understand what the guys who were talking about tech stocks were actually talking about. And I like physical things, but I mean, through this optimization process, they are able to speed things up and just make things so much more efficient. And when you make a mine efficient, you lower costs. And they are leading the industry in this. And so for so long, the tech in mining just kind of was, you know, maybe gradual improvements, small things, but this company is looking at doing something huge. And so that's why I think people should really take a look at them. Plus, they're a low-cost miner. They had high debts. They're like shaving that way down. So they seem to be doing all the right things.
That's one of the things about these big miners, is that they have been able to cut costs, and hearing that they are ahead of the game in digitization, that only further means lower costs, I think, moving forward. Sean, let's quickly go over these silver miners. You're liking silver. Recently, silver just broke out of a downtrend line since kind of the middle of last year. So you're liking these silver miners?
Yeah, and these are all recommended in one of my publications or the other. Fortuna Silver Mines, one of Latin America's fastest growing silver producers. It has mines in Peru and Mexico. They do a great job. Now, they did do a share issuance, which kind of ticked people off, but you know, they tend to use the money wisely. They tend to pick up good projects and like stuff like that. So, which is great. So that gave me a chance to buy them on the cheap. So I got in. That was very recent. First Majestic Silver. We made so much money on that last year, and then we got stopped out with big gains. We're back in them again, and they never disappoint. I mean, they have great mines that I've been to, smart teams. Another one that's really upgrading using technology. I mean, I had conversations with the people in the mines the way they used to work before the company actually came in, turned things over, and just turned things around. And so really, really smart management. Great Panther Silver. Bob Archer and his team just know how to do things right. And now their production did go down in 2016, and they actually have one of their mines offline right now. So their costs are going to go up from about $12 to, I believe the range they're giving right now is between $14 and $16, which is quite a leap. But they did that so they can improve the mine, and they always take a long-term view. So that's a company you definitely want to buy on the dips, because they know what they're doing. They have this humongous, just gigantic mining complex that has been mined since the time of the conquistadors, and they keep finding more and more silver down in the heart of Mexico. It's fantastic, and so I like them as well.
Well, John, I don't have anything bad to say about these companies. They all are kind of at the top of their game, and I guess it's just a balance of whether you believe more in gold or silver, but I think it's a great strategy to have both accessibility to.
Right. Well, I know I gave you more silver miners than gold miners, but I tried to balance it out because I'm not sure who your listeners favor. These are some great gold explorers, and I like the high grade, right? And so high grade stuff, just fantastic. Pretium, Resources, again, visible gold, just fantastic. That's actually the cutoff grade I have there, 14.1 grams. I believe the average grade is more like 16.1 grams of gold. Highest grade underground mine that is coming online in the Americas, should start production this year. They're saying mid-2017, but you know things are always delayed, so don't hold them to it. Integra, I mean, fantastic property in Quebec, plenty of upside. I mean, yeah, they only have 1 million ounces now. Believe me, they have the geology to support much more. It's just you have to start somewhere. And they're doing a bulk sample. People says, what's that mean? Bulk sample, that's how Klondike got started. They were doing a bulk sample on like Fire Creek when I went down there and making tons of money off it. Bulk sample can be very, very good. Just wanted to travel outside North America. Mariana Resources has a nice project in Turkey. Highgrade, again, I go for the high-grade projects. And again, they don't think they found the end of this thing at all. So 2.79 million ounces. They have gold and copper, spectacular grades, visible gold. They aren't going to be mining soon, but they keep hitting all the right marks to move along there. So that should be really good.
I actually just chatted with Mariana today, and it's up on our website, talking about diving more into their recent PEA, which came back with some very impressive numbers. And as you noted here, a pre-fees coming out in mid this year. Who knows, could be later this year. But they are moving along with that property very, very quickly. And as for Pretium, they're kind of in that stage where it might seem boring to investors, but they're moving towards production. So that always takes time when they get into production. And if they can start pulling that metal out of the ground, man, they could really be a good-looking stock. But
yeah, well, let me just add this. I talked to a lot of explorers, and I can't tell you how many of the ones up in that neck of the woods say, we're the next Pretium. When you're a company that all these other companies compare themselves to, you know that's a good place to be.
Absolutely. All right. Now that we've talked so much about the precious metals, there are some other sectors that we can quickly touch on here, Sean. One being lithium. Lithium is a confusing market for some people, and it has gone on a nice run, but you're still seeing a very rosy outlook for this.
Yeah, well, I mean, let's see. I just made myself a note. Morningstar analysts just came out, and they think that we will see just higher and higher compound annual growth through 2025. That's as far out as anyone wants to predict. But the demand is there. It's just growing. Now, lithium is not rare. It's all around the place. It's actually one of the original elements of the Big Bang. But trying to find it in a quantity that you can mine economically is actually tough. So I think that people can still make money on this. Yes, it's now being quoted at 15,000 a ton. That's a metric ton in like Japan, and that's high, and so you might want to wait for a pullback. And I can understand that if you do. And since lithium doesn't trade on an exchange yourself, what you do is you watch the lithium stocks. You watch Cory, Galaxy Resources, SQM, and see how they trade. And when they start to pull back, that means that the price of lithium might be pulling back. But these companies are also making great deals. Lithium Americas just has been making some great deals. And so they become a stronger and stronger company while you're waiting for a price pullback that may or may not come. I mean, it'll come eventually, but I'm just saying that this is a market that is hot. It'll be a roller coaster like everything is. But the highest peaks still haven't come, I don't think.
Well, and I know, talking to a number of different investors and listeners on our show, it's hard for them to get a grasp of the lithium industry because, as you mentioned, there isn't one, say, spot price that is readily available. Everybody is out there signing their own agreements, and that's why I think it's very important to not just get sucked up in the lithium boom and think whatever lithium company you buy will do well. You need to really dive down and understand that there is either lithium, and they do have the expertise to get that lithium out of the ground. Those are some pretty valuable considerations in my eyes. Yeah. What else are important in your eyes when people are looking at lithium companies, Sean?
The actual purity of the lithium. Not all lithium is the same. That was one thing that surprised the heck out of me. And the lithium that you usually get from the salt flats tends to be purer than the stuff that comes out of the rock. But who knows? They're always working on new processes and like stuff like that. I don't want to spend too much time on it. We actually have a report that's with Oxford Resource Explorer where I pretty much break it down. And I'm writing about this all the time at energyandresourcesdigest.com. People can check that out. And I do get into that. But I'm watching the clock, and I don't. Are we ending at 4 o'clock? Because I did want to
go a little bit longer. We have a couple of questions that we'll take care of. So
yeah, good, because I just did want to save time for anyone's questions and stuff.
Sure. Do you want to cover any more of this lithium, or people just go check out Sean's newsletter at the Oxford Club? As he said, he is covering lithium, but it can be a very confusing market, we can say.
Yeah. I was just in Nevada, speaking to some explorers out there looking for lithium. It's easy to find, it really is, but finding it in the right quantities in a place that you can mine economically, that's the real trick. But they do have some very rich deposits there. Anyway, let's move on to questions, or else.
Okay. One final comment right here is boots on the ground interviews. Everybody go check those out if you're interested to see what Sean gets up to at a number of these conferences. I've seen him recording these, and they're a good intro and a bit of a discussion around companies if you do want to check those out. That being said, Sean, one question that came in not that long ago, but it's kind of at the top of my list. Somebody says, I have a lot of gold and silver mining shares. Several of them are at a loss. Should I hang on to see if they will come back? He mentions a couple shares, ABX, AGI, and gold. Let's talk on a broad spectrum. There are a number of people who have held shares and are still holding shares that are still at a loss position even after that run up through the first half of 2016. What do you have to say to these people that can't decide if they want to book that loss or not?
Right. I really think you have to look at the underlying company and see what kind of future you think they have over the next couple of years, because you don't want to be the one that's like the girl stuck in the convent when all the rest are heading out to dance, right? I mean, you don't want your money to just sit there. But if the underlying company is strong, and if they have prospects, and they were just caught by a downturn, but they can definitely turn things around, then I would actually do it. I can't give individual investment advice. One thing, this is when an investment club is so good, because you can have someone else look at your stocks and say, look, you are emotionally attached to the stock and you just got to let it go. Because sometimes you do have to do that. But but any of the stocks that I mentioned in this presentation, and a lot more, because many of the dog stocks were just run out, they collapsed. What we talk about survivor bias. I mean, many of the surviving companies are just in great shape. All they need is a little higher prices, and they are going to ignite. And so I like the ones that I've talked about here. I can't speak directly to your portfolio, and I'm sorry about that, but I'm not your investment advisor. But really, you have to look at them. One thing that I look at is enterprise value over gold per share, which I don't think you can find that online. I'm sorry, I just realized I get that off of Bloomberg. But you just want to see if the company is increasing the value per share. If they're issuing shares every year and they're not increasing the size of the resource, then that is kind of questionable, and you might be better served just by cutting your loss and moving elsewhere.
Well, and I think sometimes you do need to just understand where that share stands and if you have gotten too emotional about it. That being said, Sean, there's a question that has come up here that says, when you're looking at companies that go through certain studies and are progressing through, whether it's a PEA, a PFS, what have you, does this excite you or does this make you more worried?
Well, it depends on what they report, really. I mean,
absolutely.
I mean, certainly because companies are run by optimists. There are no pessimists in the mining industry, right? So they will talk to you about this new PEA coming out and all this stuff, and they're so excited and all that stuff, and so they think you should buy before the PEA, and because it's just going to take off to the moon when that thing comes out. But really, it depends on your own investment outlook. And if you like to stay safer, you know what? Often when things pop right after news comes out, they'll pull back. And so then if you have a little patience, you can buy the pullback. Not that you have to wait for a pullback to buy everything, but at the same time, in this market, you shouldn't be chasing anything. If some things slip away, that's okay. There's like other things that are coming along, but definitely look at the grades that they have, because let me tell you, in this market, high grade is so important. And any good grade is good, but some guys will just try to, talk to you about this low grade project and oh, it's huge, it's really huge, and like I'm thinking, yeah, but you're a small company, and so you're gonna have to raise the money to buy it because none of the big companies wants to buy this big low grade mess. They'd much rather have high grade because high grade makes up for a lot of mistakes, which we all make. And yeah, definitely look at the grades that come out and always keep an eye on the money. Like, where are they going to get the next round of funding that they are going to need? Some people are very, very good at raising money. Other people have to issue shares pretty much every time. And every time they issue shares, that dilutes the shares you already own.
Now, Sean, there's another question that deals with grade, and this one might be hard to answer, but I think it is a very good question. What do you consider high grade? What's your cutoff, let's call it?
That all depends on if it's an open pit or an underground, and it really depends on the project because so much depends on like infrastructure. But one thing you can do is look at the companies in that area that are making money and see what their average grade is, because mines never turn up alone. They're always in groups because they're always following trends, right? And see what the average grade is for the mines in that area. And is the project you're looking at, is its grade higher than average in that area, or is the grade lower than average? If it's higher than average, you know what? That could actually excite the interest of the other companies there that are always making money and are looking to put that money somewhere. If it's lower grade, well, it's going to be hard to convince someone else to either pick them up or to actually put money in there. So, just looking at those things, I don't have a specific cutoff. I tend to look at groups and see what companies in an area are like actually mining.
Now, Sean, there is another question here. It's a little technical, I guess you could say, but how much do you pay attention to trading volumes when you're looking at stocks?
Well, I actually have to pay attention quite a bit because I write for publications that have subscriber bases, right? So an individual can get away with things that I can't. And in fact, we have big discussions at work about this, and they use a formula for my stuff. They multiply volume by the price, and so they give me more leeway on a higher price stock that has lower volume. But if it's a really low price stock, and you're saying what's a really low price stock, for where I work, if I want to buy anything that's like less than 90 cents, then I have to have a discussion. So that tends to be problematic, especially when we had that bear market, because there were so many amazing companies trading for dirt cheap. It was just blowing my mind, right? So we had big discussions at work, so we just had to have, this is it. So for what I do, because I have subscribers, even in my Golden Resource Profit Hunter, which has a smaller base, if it has less than average volume of 150,000 shares per day, I don't do it because my subscribers will push it around. If you're on your own, for one thing, you can snipe. You don't have to go in with a market order. You can say, come down and meet my price. You just have to remember that at some point you're going to want to sell too, right? And yeah, maybe the volume will increase because everyone will realize this is an amazing company, and so everyone's pouring into it. Or maybe they won't. So that's the thing, is the lower volume you get, the harder they are to sell. So I would definitely be careful as an individual if like anything was trading less than like 75,000 shares a day, but you have to be your own conscience on that.
Absolutely, and it all depends how much money you have and how much you're willing to put into the company. Obviously, the more money you have, the higher volume you need because you always do need that exit strategy.
Right,
Sean,
but
yeah,
you shouldn't focus on just one company and say this is the one that's going to make me rich and put all your money into it. There are people that do that, and that is such the wrong thing to do. And I'm sure that your listeners are sophisticated enough not to do that. But I always want to put that disclaimer in there. Don't say, okay, these are the companies Sean recommended. I'm going to take all my money and put them in them. No, learn
no,
position
I
sizing, learn position sizing, and just spread things out. You don't have to hit a home run and make a fortune every time, and it's not likely you will. So just spread things out. That's all.
One thing I also argued too is if you do hit a home run with that stock, I hope that you've been selling a little bit even on the way up and maybe buying on some of the dips because that's truly how you can maximize your profits when stocks naturally get a little ahead of themselves and more recently than not a little lower than they probably should. But Sean,
Yes.
it's been a great webinar. I appreciate all of your time. This webinar will be posted on our website, kereport.com. If anybody has any follow-up questions for Sean, feel free to email me, fleck@kereport.com. And in the meantime, hopefully the market continues to move up. And Sean, one final question, because the Super Bowl is right around the corner, Patriots or Falcons?
Oh, what? I have to alienate half your listeners now? But I
That's
am
why we
from
left
New
it to
England.
the end, Sean.
I am from New England, so I was raised a Patriots fan, so I just have to go
Hey,
that way.
well then that's a very good reason. At least you were raised a Patriots fan. Well, it's going to be an interesting weekend, and I hope
It is.
everybody enjoyed this webinar. Thank you all for tuning in.
Thank you very much.